Hey, Steve Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you can sort of value entertainment out of these videos, I'll ask you a thumbs up and subscribe. Questions, comments, put those below. We're going to do a deep dive here on the Canadian housing market. There's obviously a lot happening. Everyone's kind of tuning in here, trying to figure out what moves to make. We've also got some update on the inflation figures, etc. So let's kind of open it up with that, which has really been the theme of the show for going on the past 18 months, which is inflation. It's been stubbornly, persistently high. And we got the recent data for April, so inflation up 6.8% on a year-over-year basis. Shelter inflation, which we know is an underreported statistic, that was up 7.4% year over year. So that was the largest increase since 1983. So shelter inflation is finally popping through into Stats Canada's CPI inflation. So this is, again, putting pressure on the Bank of Canada. You look at inflation, it's still stubbornly high. You've still got, 30 plus year highs in inflation. And I don't see that going away over the next couple months. We will eventually taper off and roll over towards the latter half of this year, but that's not in the cards over the next couple months. So if you look forward and say, okay, well, the Bank of Canada's next meeting is June 1st, you're getting 50 basis points. You're going to get another 50 basis points increase. And that is going to immediately impact, again, the housing market moving forward because, as I've talked about in the show numerous times, in different interviews, I always said, listen, 3.5% is kind of the magical number. Once mortgage rates get north of 3.5%, you see the slowdown in housing, especially in these highly levered markets like Vancouver and Toronto. You got your 5-year fix today. It's gone from 2.5 to, today again, 4.5%. Your variable today is around 2.5, give or take. So once that rate hike comes from the Bank of Canada in June, that's going to push all these variable rate mortgages north of 3%. And so again, that's going to be a continued tightening on the Canadian housing market as borrowing costs continue to ratchet up. And so I think that's kind of what we're starting to see. We're seeing that filter through, obviously, into the national housing data as well, where you're seeing sales coming off, for example. You're seeing sales activity weaken. And so if we look at, national housing, home sales were down 20% on a year-over-year basis, 21% on a year-over-year basis. Now, again, keep in mind that last April was an all-time record high. So naturally, you're going to slow. We're always going to slow. Regardless if rates just stayed where they were, housing sales were going to roll over because you can't beat back-to-back years of all-time record highs in home sales. Eventually, markets fatigue themselves and sort of slowly die off. So we are kind of going in that direction either way, and then you tack on the single largest increase in mortgage rates in the past 40 years, right? We've gone from 2.5% on your typical 5-year fixed mortgage to 4.5%. 200 basis point increase in roughly 6 months is a massive move. It's not a normal move. So again, so you've seen that 21% decline on a year-to-year basis, but even if if you go month over month seasonally adjusted, that's where things get interesting because you still had basically a 13% decline in national housing figures, and this slowdown is more pronounced. We're seeing in Ontario 21% decline month over month seasonally adjusted. So everyone's kind of hearing these horror stories of suburban Ontario or all these markets that saw huge run-ups in prices, huge speculative activity, feverish activity. You're seeing those markets now obviously selling off. We're hearing the stories of people that paid too much at the top of the market that are trying to back out of deals, that maybe bought and haven't sold their existing property and are now stuck with a property that either is illiquid or is selling for valuations much lower than they need. You're seeing appraisals come in lower than what people purchased them for. And so we're seeing some distress, and I think we're seeing some distress selling in very small parts of these markets, and particularly these suburban markets that have really inflated the most, partially due to, I would call it the COVID trend or the pandemic trend, which was, hey, listen, I no longer have to work from the office. I can work remote. And so let's push up prices 45 minutes to an hour outside of the city. And so you're now seeing the sharpest pullback in these markets. So if I look at, Ontario, for example, Keep in mind that house prices tend to be very sticky, right? They don't. This is not the stock market. They don't just get cut instantly. Home sellers are typically very reluctant. They kind of drag their feet. But if you look at seasonally adjusted prices in Ontario, down 6.3% month over month, that is not a normal move. Again, this is not an average home price. This is using a home price index, which is kind of a smoothed out lagging index. It actually uses a 3-month rolling average. So to see a 6% decline on a monthly basis in Ontario, again, the rest of the provinces were virtually flat, tells me that most of the stress is happening in Ontario, where I think there was a lot of leverage and speculation in those markets. But again, this is not a normal trend. And so what we're seeing is, if you unpack it further, you can see that months of inventory is actually still quite low. We're like nationally, we're at 2.2 months of inventory for sales. So typically you don't start to see downwards pressure on home prices until you get to 4 to 5 months. But I think what's happened is just been this abrupt shift in the market, in liquidity conditions. Again, when rates go from 2.5% to 4.5% in the span of several months, that makes a large difference. And speaking of a large difference, I've talked about this before, and everyone goes, "Well, show us your numbers. Show us your numbers." It's like, guys, it's extremely simple to do. All you have to do is take the National Home Price Index, which again measures national home prices on this very smoothed out index, and you take, let's say a 30-year amortization, and say, okay, well, if the National Home Price Index is, let's say $800,000, and we take rates at 2.5%, and now say they're 4.5%, your typical payment's increasing by about just under $800 per month over the past 6 months. So suddenly there's been this huge payment shock, and that's why we're seeing housing sales and housing activity rolling over. Something is going to have to give, and that something, in my opinion, is going to be prices, right? Like, buyers are basically stepping back and saying, well, maybe I should wait 2 or 3 months because I'm going to get an extra 5% off. Maybe I should wait. Maybe I should go rent for another 6 to 12 months and get a better deal, because this thing is, something's got to go. And so that's why you're seeing, I think, this freezing up in activity. And in fact, if you look at the rental market, I mean, the rental market is blistering hot across pretty much all of Canada. Again, I follow the Vancouver market, the Toronto market, and really the Calgary market. Those are kind of my 3 markets. And the rental markets are out of control. I mean, there's very little vacancy. Rents are up significantly. And this is typically part of the late cycle dynamics as well. As home prices go up, wages tend to follow as well, and that tends to push up the rents and create vacancy tightness as the unemployment rate falls down, and you get an expansion in household composition, right? So people basically say, hey, I'm going to leave mom and dad's basement and go rent a place because I just got a fancy new job. So these are all contributing to a very, very tight rental market. But again, the focus on this report is ultimately what's happening on the ground in across Canada. And so from a rate of change perspective, it's important to understand is the Bank of Canada is going to be looking at really 2 things. I think they're going to be looking at month-over-month price declines, which we just had our first decline since April of 2020. So national home prices declined 0.6% month-over-month, the first monthly decline again since April of 2020. But prices are still showing as up year over year, all right? Because again, it's a base effect. We went from a 29% year over year gain to now we're down to about 24% year over year. And that will continue to roll over until you'll see negative year over year price declines probably in the early parts of 2023. And that is going to have larger ramifications when you consider the fact that so much of the Canadian economy is directly related to housing. I mean, housing is, so there's an old analogy that basically, housing is the business cycle. So basically all you have to do is watch housing, and that's kind of going to tell you, where the business cycle is going. Housing is like kind of the leading indicator because it plays such a large major component of economic growth, particularly here in Canada. So residential investment and household consumption, which they go kind of hand in hand. Residential investment and household consumption account for 85% of real GDP growth over the past 5 years. So it accounts for 85% of real GDP growth over the past 5 years. Housing is the economy. And so that's why we have to kind of watch this whole scene. All that matters is just watch housing. That will basically tell you where the economy is going to be 12 months from now. So as I said before, we didn't fight the central bankers on the way up, and we're not going to fight them on the way down, which is to say that I think that they're going to over-tighten. There's the political pressures to raise rates. Again, I thought that they would maybe balk prior to, but again, there's no sense of being married and stuck to one singular opinion. I will be, once the economy rolls over into the dumps, because that's clearly what they're telling you they're going to do, is they're going to hike rates to basically stave off inflation and kill the economy, aka we're going to kill housing here, at least temporarily, in order to bring inflation at least closer back down to target. Then there's really no point in stepping in the way and trying to sort of fight that view. So again, that's kind of how I'm looking at markets right now. Like I said, I think that the most vulnerable segments of the market continue to be the suburban markets, which have gone up the most. As I said, particularly we're seeing that sell-off happening right now in Ontario. But I mean, I've seen examples here in Vancouver. You look at Langley, Chilliwack, Mission. I mean, there was a house the other day that sold for $750,000 in Mission. I mean, I can tell you that at the top of the market, this house 3-4 months ago was going for probably $950. So you're seeing a sharp sell-off in these markets. It's no surprise we actually had, one of the big bank economists was calling for a 20% correction in parts of the market, and I think he's going to be right. Again, I'm not going to name names there, but you don't see that publicly published, because no bank can come out with a negative view on housing. Again, as we know, this channel here is agnostic. I could care less if house prices are going up, house prices are going down. This is supposed to be the channel to provide you guys with value and insights into the housing market, not only from a data and analytical perspective, but from a feet on the ground perspective. Because as I said, we're seeing that sell-off, in particular these suburban markets where most of the growth was. But if you actually come back down into, for example, in the city, I can tell you for a fact that, parts of the market still remain incredibly tight because inventory is not inflated. We don't have, even in the suburban markets, you don't have 5-6 months of inventory for sale. You're still at like 2.5 to 3 months of inventory for sale. So it's just a market that's suddenly become illiquid. And so once I get more concerned, once that inventory actually starts to build to sort of more balanced or healthy levels, that can actually put more price pressures on the market. Because if I look here at the inner city, a lot of the condo market in Vancouver, which didn't have a whole ton of price appreciation during, the last 18 months during this pandemic, 24 months, that market right now is still sitting sub 2%, sub 2 months of inventory on the market. So you're still seeing multiple offers across a lot of the product for the inner city sort of Vancouver condo, particularly at these price points, right? So where the main price pressure or like competition is at the entry level points, right? So if you're looking for a condo, sub $650,000, I can guarantee you're going to be competing probably at least half the time, because you have this sub segment of everyone trying to squeeze into the market. It's all they can afford, especially with the rates at 4%. So that the floor of the market actually seems to be moving up. Again, I suspect that's going to eventually taper off, but that segment of the market still remains incredibly competitive. So as always, when we talk about, national housing and provincial-wide markets or even suburban markets, you have to understand that markets are still very micro. There's pockets of the market that I think are selling off aggressively, and there's parts of the market that are still actually holding up very, very well. There's not necessarily a national housing market, but when we talk about national housing market, I use it as a reference point to understand how policymakers will look and perceive markets. Because when they see, national housing markets selling off or national housing activity at a standstill, that's when policy changes start coming into play for various reasons. And so, like I said, right now there's too much political pressure on the Bank of Canada. Inflation remains stubbornly high. I don't think that the Bank of Canada can print more oil or grow more grain. But at the end of the day, what they're going to try to do is they are going to try to kill demand, and that demand is primarily focused in the housing market. They're going to be steps and steps behind, and this is, I think, the channel, which is the leading indicator channel, because we try to look at a lot of anecdotal stories of feet on the ground perspectives. So as always, hope that helped, and we'll see you next week.